Hello, my name is Tyler Vernon, Chief Executive Officer of Biltmore Capital Advisors. Biltmore Capital is an independent financial planning and asset management boutique working with clients throughout the United States. Today I want to introduce Dr. Donald Chambers, our Chief Investment Officer. Don is going to talk a little bit about a very interesting strategy that we use here in our clients' asset management portfolios called a closed-end fund strategy.
Hi, my name is Don Chambers. I'm Chief Investment Officer at Biltmore Capital. And I'd like to talk today about an exciting strategy which involves investing in closed-end mutual funds. It's a strategy that I think through time is one of the most valuable, most return-enhancing strategies available on Wall Street. Now, to understand a closed-end fund, I'm going to compare it to its close cousin, an open-end mutual fund. And that's what most people are familiar with, the large and open-end funds of firms like Fidelity and Vanguard, where you simply buy into the fund and you sell into the fund at the firm's net asset value. Now, the fund's net asset value is simply the value on a per-share basis of the fund's underlying portfolio. So a fund takes its portfolio, divides it by the number of shares, and comes up and says that each share has a net asset value of, let's say, $20 per share. Closed-end funds are not purchased to and from the investment company. Closed-end funds are bought and sold in the marketplace. And what makes them special is that the value that you buy and sell the closed-end fund at is based upon market pressures. And sometimes you can buy the closed-end funds at large discounts, meaning it sells for far less than its net asset value. And sometimes you can buy and sell at values above the net asset value, at premiums. So the goal of an effective closed-end mutual fund strategy is to use fundamental and technical analysis to identify those funds that are trading at attractive discounts, buy them, and then get out of them when that discount is narrowed. So for instance, if you purchased a closed-end fund at a discount of 15%, and a year later you got out of the closed-end fund when it had a discount of only 5%, you could actually add 10% to your annual return. Of course, the challenge is trying to figure out what is a good closed-end fund discount to get in at and what is a good closed-end fund discount to get out at. And it's not as simple as simply looking at the raw number. There are closed-end funds usually, some of which sell for discounts as great as 30 or 40%, and some sell at premiums of 20, 30, or 40%. In trying to ascertain whether that closed-end fund discount is attractive or not, we need to look at more than just the raw size of that discount. We need to take into account other factors, especially the expenses and management fees of the underlying fund structure. I've been using closed-end funds and the closed-end fund investment strategy in my personal and professional life for almost 25 years, and I find it's one of the most exciting opportunities for enhancing returns without substantially enhancing risk.
If you have any specific questions about the strategy after listening to Don, please feel free to give us a call directly here at Biltmore Capital.